I am going to just walk through something that we didn't get to go over on the call last night really quickly, which is using the options profit calculator to figure out which strike price and which premium you should get based on your situation, right? So this is the options profit calculator. I'll drop this link in the group. We are going to focus on the long call for now. You could do the same thing with the puts, but these two are the primary ones that you want to look at. I'm just going to focus on the calls right now. So I'm going to click on long call. It'll take me here, right? So you just go ahead and put in your ticker symbol. I'm just going to go with Starbucks because that was one of the examples that we used on the call last night. So just coming in and looking at Starbucks, right? Looking at this, the 3 month timeline, I can see like, okay, so at this point, that's when all the Corona stuff started happening, and Starbucks is slowly inching its way, back up to where it was. So let me look at the expanded chart so I can see some stuff. The blue line is my 200-day moving average. The yellow line is the 20-day moving average. And let me put it for 3 months because I want to see 3 months. So right now, right, it's trading above its 200-day moving average. And then the RSI down here, so it's showing like this is the range. The RSI is from 0 to 100. Right now, it's like right at, what is it, in the 70s? So usually when it's outside of this orange range, that means that it's oversold, which means there may be a correction coming. In the past, based on what I've been doing with Starbucks, usually when it is oversold, like right here, for example, it corrects. And if you look again right here, right, when it's oversold, it corrects. Oversold, it's above this orange, it's going to correct, right? The timeline at which it corrects, I will have to do other analysis to figure it out. But for right now, I can see it's trading above its 200-day moving average. And the RSI is indicating that it's a little bit oversold. So just to keep that stuff in mind, like I'll come in and look at this and see, okay, let me figure out what I want to do. And this is not financial advice. I'm not telling y'all what to do. I'm just telling y'all some of the stuff that I look at and some of the things that you may want to look at. So now I'm going to click on Trade SBUcks options. It's going to pull up the options that are available to me, right? I'll make sure that buy and call are picked because I want to buy a call. And then the expiration date. So you can pick different expiration dates. For the examples that I went with, the first one that I wanted to do is one that was way out the money. So I think I did, what was it? I did the 77.50. Wait, which one? There we go. So for this one, I did the $82 call. So let's look at that, right? If you come and look at the May 15th $82 call, this call is out the money, right? Way out the money because the price is at $77.98 right now. The $82 call, let's open that one up. So it costs 20 cents, which is very affordable to me as a person who's just getting started and I only got like $100, right? That means I could buy like 5 contracts of this, which might seem great, starting out. But let's, remember we talked about the deltas on the call last night. The delta here is 12 cents. So that means for every dollar change in the stock, my options contract is going to go up 12 cents, right? And then with my gamma, that means my next delta is going to be like 17 cents. So for the next dollar change, it's going to go up 17 cents and so forth and so on. So there's not really a lot of movement with this because out the money contracts are not as affected by delta as the ones that are in the money. And we'll get to that. But for now, we're just going to look at this one. So the $82 one, if we look at the implied volatility, it's basically assuming that there's a 31% chance that this move, like a move that big, will happen by the expiration date, which is the 15th. Like a move that big will happen in that short period of time to get me to where I need to make money. So if I come into the options profit calculator, right, you put your ticker price in. You could hit get price. Sometimes the prices are different just because, the load time. So I'm going to change it to what it is showing in Robinhood so I can have an accurate reading. I picked that. You hit select option. You come over here and make sure you pick the correct expiration date. We said May 15th, and we said we were going to do the $82 call, right? So $82, right? Calls over here, puts over here. So I'm going to pick the $82 call, which is 20 cents, just like it was in Robinhood. And I have $100, so I'm going to buy 5 of them. Then I hit calculate. And it shows me, right, what my potential profit could be. So, for example, if I buy it, I'm going to pretend like I'm buying this tomorrow. If I buy this tomorrow and it just so happens on Monday that Starbucks stock shoots up to $83, right? I would make a nice little chunk of change. And honestly, this is what I think is happening for a lot of new people that come into the group. You know, we get these out the money options and we just so happen to get them just at the right time as the stock's taking off or as it does a run or a peak or something. And we get these big profits. And then coming back down from that, you know, we trying to figure out what the hell happened. So what this is showing you, right? This is since it's so far out the money, there's no intrinsic value. It's all extrinsic, and extrinsic is affected by time decay. So if you look, if it stays at $78, like let's say it only goes up to $78.33, right? It goes up $1. If it does that, right, and it stays like let's say it just hovers between $79 and $77 the whole week, you are going to lose money because there's really not a lot of time left, right? There's not a lot of time left on this option because it's expiring on the 15th and you will be in the red and you're losing money. Whereas, let's say, let's come back. I want to compare because I want y'all to see the difference. So we picked the $82, which is out the money because it's a call and the price is at $77.98. Let's say we come down here and we pick something that is in the money, right? So a $77 call is 98 cents below the strike price. So that's in the money. And I think that's what I picked. Let me see. Yeah, I picked the $77.50. Right? So this one. I picked the one right below. So we open this up. Look at this delta, right? Options contracts that are at the money usually hover around that 50 mark, like somewhere in the 50s. And this delta, right, another way to tell besides just looking at it that this one is right at the money is that it's like trading right at 54, right? So for the next dollar that my stock goes up, when my stock goes up to 78.98, my options contract will increase by 54 cents, right? So all my 100 shares will go up by 54 cents. So let's throw this one in the options profit calculator, right? Got my ticker. I made sure I selected the right one, right? And let me see what it was the same May 15th expiration. And it was the 77.50 call, right? 166. Let me check. Yep, 166. Okay. I'm going to pick my 166. I'm only going to buy one because I got like $100, $200 to invest. Sorry, close that out. And then I'm going to hit calculate to see what happens. So now if you notice the difference, right? This is the same expiration date, but the strike price is different. This chart is if I chose 82. You see how that the loss is eating up into my green? That's because since this option is out the money, is purely extrinsic value, and the time decay is going to eat away at what I have. Whereas with this one that's more in the money, the red is more subtle because yes, there's still time decay, but a lot of my I have that cushion from having an in the money option where I have intrinsic value, right? So let's compare. Let's say right, so just to remind you where we're at, I paid $166 for this in the money call, and it's just one contract. Whereas with this one, I paid $100, right? But I bought 5 contracts. So if you notice the profit difference, right, with this one, and this is why a lot of people get lucky with this, right? This one is more risky, but you know, when you look at your risk reward profile, right? If the stock jumps up to $84 on Monday with this one, I'll make $1,000, right? Minus my initial investment, I'll make $1,170. Whereas with my in the money call, if the stock jumps up to 84 on Monday, I'll only make 492, right? So for some people, they may say, well, shit, I want the one that makes the most money. But you also have to remember that this one also has the most risk. And oftentimes, these jumps, they're not guaranteed. It's not likely, but it could happen. And this is where people get lucky. And, let's say it spikes up and you miss it, right? But it comes back down to 79. Or let's say, even if you use the example where it only bumps, let's say it bumps up and down between 79 and 77 for the rest of the week. If it doesn't go above 79 for the rest of the week, you're losing all your money. Whereas with your in the money option, right, let's say it bumps up and down between 79 for the rest of the week, you still have until the 13th, really and truthfully the 14th, to still make money. So the day before expiration, right? So let's use that $79 mark. The day before expiration for my in the money contract, if it stops at 79, like the stock won't go above 79, I'll still make my $12, right? Whereas with my more riskier options contract, if it doesn't go above 79, by the time we get to the 15th, like at the 14th, I'm losing $70 because the extrinsic value, like the time decay, ate away at my extrinsic value. So this is just a really short, comparison and a way to look at the difference between buying at the money and in the money options contracts versus buying the ones that are out the money. If you know that it's running up and it's gonna do something, like you're getting in on the tailwind. I mean, not the tailwind. Sorry, you're getting in on the beginning of it. Like you're lucky enough to get in right when it starts running up. Then yeah, this strategy could possibly work for you, and you can make a decent amount of money. But you could also get burned very easily if the stock reverses and goes in the other direction, right? Let's say you get in at 77.50, and the next day, like, or the next couple of days, it immediately starts to go back down to 75. Once it goes to $75, you have lost your entire investment. And Starbucks has been doing that. So it's like it's a game of chance. It's probability. If you got money that you want to play with and you don't mind losing, and you want to experiment with some of these short expiration dates and out the money calls with cheaper contracts, to try to win some of these short, be my guest. But if you're taking the slow and steady route, you may be better off looking at some in the money calls. Again, it all boils down to your strategy, your risk tolerance, and what you have. But I just wanted to show you all really quickly just the difference between the profits on the in the money contracts and the out the money contracts. So hopefully this helps and it makes sense. If you want, you can drop your comments or questions below this video. I'm about to post it in the group as soon as it finishes downloading. And thank y'all for watching. Thanks for coming to the video last night, and I'll talk to y'all soon.